Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Friday. Oh, thank God it's Friday. I really needed it. This has been a crazy week for everybody around the world. And by the way, I feel so bad for what's happening in Ukraine and Russia. My heart goes out to people that are fighting this war right now, this stupid, baseless war on both sides, Ukraine and Russia. It's Friday, February 25th. Monday is going to be the last trading day of the month, and it's going to be the last day of the month. February is a short month. As we all know, we have 28 days. It's about 7:52. The market's going to open up in about an hour and 38 minutes. I'll keep it short today since it's a Friday, and I want to deal with just the key points. So, as you can see here, we're down a little bit beyond random, but based on the volatility that we've seen yesterday, the Dow down 800 something points, being off 150 points in the morning pre-session during war is really not that bad, okay? It's really not that bad. Let me show you the put-to-call ratio. We're still near 1. Anything above 1 is telling us that the market is overdone to the downside and we may pick up. Now, I want to show you momentum levels because this is something I've never seen before. I want to show you this. Look at the number of stocks in the NASDAQ trading below the 50-day moving average yesterday. I want you guys to see this. This is crazy. Look at this. Look at the level we're at right now. We're right at COVID levels, which is right here. So the market looks really low right now, like really low, like we're bottoming out here. Yesterday during the day, we went to like 5, which was even low, which was the lowest. So we are there. Now, we may gyrate a little bit. We may go hiccup a little bit. But the bottom line is we are as stretched out as we can be. That's the number of stocks in the NASDAQ 100. Now, if you look at the NASDAQ 100, the number of stocks below the 200-day moving average, you will see that we're almost there as well. So, I mean, 27, another 7 stocks, we're really close to the bottom. Now, again, we could go a little bit lower, but again, we're not here. We're here. So expect more volatility, expect more trading range. But in terms of momentum levels, I mean, we're really close to the bottom. I don't think the market's going to go that much lower. I really don't. And on the bond market, look at the bond market. The bond market is lower, not higher. The fact that the bond market is reverting, and this is really important. Pay attention, folks. This is time well spent. And by the way, folks, if you're getting value out of these videos, if I'm helping you navigate the markets, do me a favor. Send me an email, support@marketgeeks.com. That's support@marketgeeks.com, and tell me if I'm helping you out. So as you can see here, with the stock market going up, the bond market went down yesterday. We opened up at 139. I wanted to short it at 140, but we didn't get up there. And now we're all the way back down to where we were pre-level. That's telling us that investors are not fleeting to quality. They're actually going ahead and selling bonds, which means interest rates are going higher, which means the public, the investing public, believes that this war is not going to deter the Fed from raising rates. I'm going to repeat that again because what I'm saying is really important. The bond market is telling us that it doesn't believe that this war is going to cause the Fed to pause on their rate hikes. That means things are going to go as normal, which means there's not a lot of fear of the war. Because if there was a lot of fear of the war, the bond market would go up, because that's called flight to quality. Whenever you have acts of wars, natural events like tornadoes, earthquakes, when uncontrollable, unforeseeable events, the bond market goes up. That's called flight to quality. We had flight to quality for one day after one of the biggest war since World War II. And right now we're already below that. That's telling us that the bond market is completely fading this war, which is a good thing, which is bullish for the stocks. And it also confirms, based on what we've seen yesterday with the market skyrocketing, that most of the downside is priced in. And it's also in line with what we're seeing on momentum levels. So momentum levels, the bond market, and the stock market, and volatility, and market internals are all pointing to higher prices in stocks, okay? Or if we do stay around these levels, we're talking about very little till we bottom out. So we're either there or we're almost there, okay? And again, three or four different things are telling me the same thing, including the bond market, which is already below yesterday's low or right at yesterday's low. Let's talk about economy a little bit. We had GDP yesterday at 7%. If it wasn't for the war, that would be very significant. But with the war, the markets just brushed it off completely, which makes perfect sense. But the number came in at about 7%, I think, which was near the target level. 7%, that was the expectation. Personal consumption, 3.2, 3.1, not within line. So that's giving the Fed the green light to say, we told you so. We told you that things are running a little hot. We can go ahead and raise rates, which is another reason why the bond market is lower. Because remember, there's an inverse relationship between bonds and interest rates. So if bonds go lower, interest rates go higher. All right, understand that. Today, and jobless claims were rising just a little bit, but honestly, none of this really matters right now. It's all about the war, or at least for the next few days. Today, we've got durable goods. That's going to be a big report that's coming out in 33 minutes. Consumer sentiment, which is typically a big report, but we already had Redbook. We already had the GDP. This impacts retail sales. So we may get a good bump on retail sales after this number. Keep your eye on these numbers, especially durable goods and personal income. These are going to be the big ones, and they're coming out 33 minutes from now at 7:57. So keep an eye on that. Speaking about world economy, you know most of what's on the table right now, but I want to go through this for those of you who do not. World shares advanced Friday. U.S. futures were lower as Russian troops pressed towards the capital of Ukraine. But again, what this isn't telling us is that we opened 800 points or 900 points lower on the Dow and filled the gap yesterday, okay? So the fact that we're down 150 points on the Dow the day after war, I don't think that's all that significant. Crude oil is hovering around $100 a barrel, and as I predicted about a year ago, and most commodity prices are going to be inflated because of war. It's just very, very simple. Basic materials, commodities, these things go higher, especially oil prices. When there's acts of war, there's a shortage, potential shortage, commodity prices go up. Despite uncertainty about Ukraine, worries over inflation, overnight turnaround on Wall Street seem to be very bullish for Asian and European shares, and I think that rally is going to continue today. I think Monday we may see a down day. I think we're going to see a bullish day today, especially if the Fed data is okay. Investors appeared relieved that the sanctions against Russia were not as severe as they might have been, even as Ukraine's president pleaded for international help to fend off an attack that could topple his democratically elected government, cause massive casualties, and ripple out damages to the global economy. And folks, this is a bad time for the world, but it appears that the stock market is pricing it in pretty well. Russia was pressing its invasion of Ukraine to the outskirts of the capital Friday after unleashing airstrikes on cities and military bases, sending in troops and tanks from three sides in what amounts to the largest ground war in Europe since World War II, and the bond market is down. That's amazing. That's really amazing. And volatility, and let's look at volatility. Let's look at VIX. By the way, we bought a put on VIX yesterday. Let's see how responsive VIX is. It's not 0.59%. So volatility is really behaving itself really, really, really well. Now, here's a comment that I like from Ipek Oskardetsky. Market players might be betting that the crisis could slow down moves by central banks to cool inflation by raising rates and unwinding other support for pandemic-burdened economies. Now, what he's saying here, right here, is exactly what I was pointing out right here, that acts of war causes the Fed to say, hey, we're going to hold off raising rates. But it doesn't seem to be the case. Look at that. We had a one-day rally in bonds. One-day rally where we closed at the bottom and we're already lower. So, what Mr. Ipek is talking about, and I was thinking that may happen too. This is very normal. It doesn't appear to be the case, at least not by the price action. The Russian invasion of Ukraine caused a barrage of new targeted financial sanctions meant to isolate, punish, and impoverish Russia in the long term. Yeah, I'm holding my breath. U.S. and European officials have held back on one key financial measure. Oh, we forgot. We're going to punish them, but except giving them the biggest one, SWIFT. Choosing for now not to boot Russia off SWIFT. That's wires. That's how the wires around the world get, which is like, that's the dominant system of global financial transactions. Hey guys, we're gonna cut you off of all the of everything except the biggest one. mean, come on. If you're going to cut them off of SWIFT, right? Japan on Friday announced new sanctions on Russia, including freezing assets of Russian groups, banks, and individuals. And guess what? Putin has a lot of money outside of Russia. That may impact him too. Suspending export of semiconductors and other sensitive goods to military-linked organizations in Russia. Good. While most nations in Asia rally to support Ukraine, China denounced sanctions against Russia, blaming the United States. It's our fault that Russia and Ukraine are going at it. It's all our fault. I mean, come on, get out of here. Russia and Ukraine are major producers of both energy and grains and other commodities, and the conflict will push commodity prices higher. Prices for energy have surged more in Europe than in the U.S. because its economy is more closely tied to Russia. Spot prices for natural gas have jumped more than 50%. We've been talking about prices on natural gas going higher and higher. Expect inflation. Higher energy food prices are amplified after inflation, which in January was the hottest level in the United States. But again, the war is overshadowing the GDP yesterday. The Federal Reserve looks certain to raise rates beginning next month. We'll see if that happens, although it sometimes has delayed big policy decisions in time of geopolitical uncertainty. The bond market is not saying that right now, such as the Kosovo War, U.S. invasion of Iraq. Economists say they still expect it to tamp down inflation. I do as well. A major concern is whether it can do it without choking the economics into recession. I believe it can. I believe the market is bottoming out. And the fact that interest rates, the bonds, are already below yesterday's low, boy, oh boy. The fact that volatility is, I mean, look at this. Look at VIX. I mean, it's up not even 1%. I mean, looks like we're topping out. So, and look at, I mean, this looks like we're about as high as we're going to go. It looks like we're going to go lower. So the bottom line is things are looking better than expected. Now, I knew that we were going to have some shenanigans with Russia over the last few weeks. So what did I do? I shorted a couple of trades. We shorted a trade right here, international paper, held it for 16 days, got out right here, made a juicy 37.25% on it. That was for Sniper program. For microburst, we shorted GNTX. We shorted it on the same day on the, let's see here, 223. 23, where's the 23rd? Right here, right there, somewhere around right here. And it went down, and then it went back up, and then it went down, and we covered our short for 21.21%. So 37.21% on Sniper IP and 21.21% on GNTX microbursts, held both for 16 days. Again, keep your eye, folks, today. Keep your eye on the SPY. I'm going to give you some good advice. If we take out this high right here, and we're not that far away, if we take out this high, I think we're going to go to the 200-day moving average. Then we may have a little pause, but I think we're going to get to the 200-day moving average. So the levels you want to see broken are the 430 on the SPY. On the QQQ, those levels are 343.95. And on the bonds, too bad I didn't get in on this short. I wanted to short this right here yesterday. I had an order at 140, didn't get filled. And on bonds, if we go lower on bonds, that's a sign that the market is going to recover and it's brushing off the current news. Now, before I let you go, I got to tell you something important. Investors are trying to figure out the market's next move, right? Russia began its invasion on Thursday, causing panic in the stock market. Savvy investors like you guys saw this as a buying opportunity and drove a huge rally throughout the day, right? There's no question about it. Stocks are cheap compared to prices a couple of months ago. Are we reversing the bearish trend? Wondering where stock prices will go next? So many traders want to know what's happening next. Well, I got a great solution for you. Jeff Zananeri. And by the way, Jeff alongside me said to you guys that oil was going to go to 100 a year ago. And he told you about Kathy Woods too, remember? Oh boy, don't get me started. Jeff Zananeri, who's an absolute this guy's on a tear. He's announced the biggest prediction of his career this week, and he wants to share his answers with everyone, including you guys. This is the time to hear what Jeff has to say. You're going to learn all about volatility, market direction, what to do, what not to do. Click the link below to watch the broadcast. Do it now. Follow the link below this video if you're watching it on the Wealth Press YouTube channel and learn about his approach to the current stock market environment. Follow the link below this video if you're watching on YouTube. Do it now. And Monday, oh boy, weekly outlook, biggest threats, biggest opportunities. Wonder what's going to happen with Ukraine? I got you guys covered. And again, if you're getting value out of these videos, if I'm helping you navigate these markets, send me an email, support@marketgeeks.com. Bye, guys. Have a great weekend and get some rest. We're going to get out of this in one piece. Bye.